la 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 la. So money-minded.
I think the really big concern is that we actually know so little about what's going to happen after January 1st. It pays to hope for the best, but plan for the worst. So I'd say make sure you have at least 3 months worth of spending in a bank account as a rule of thumb, just in case anything should happen. So the Bank of England has already made 2 mammoth cuts to interest rates this year. Central banks tend to cut interest rates when the economic outlook isn't good. Low interest rates mean cheap borrowing, so hopefully people invest more and that stimulates the economy. But it's actually not ruled out the prospect of interest rates going negative, so that could potentially mean that you have to pay the bank for the privilege of it looking after your money. For mortgage holders, low interest rates actually aren't a bad thing because it means you're paying back less. But if interest rates do go negative, don't expect your bank to be paying you to hold a mortgage with it. So currency rates absolutely hate uncertainty. And since the referendum in 2016, the pound's lost value against most currencies. This is really bad news for holidaymakers because you've got less spending power abroad. It's also bad news for people who want to buy a house abroad. What happens after Brexit, that will depend on the quality of the trade deals we get. But if you're really worried, I'd say try and lock in an exchange rate now, just in case the pound falls further. So if we do get a trade deal, that'll really buoy the value of your spending money abroad. It's really good news for holidaymakers. So pre-COVID, Brexit was the big property market story of the day. Everyone was very worried that it was slowing down sales because of the uncertainty. But now it looks like the pandemic's going to be the big market mover of the day. So the government's announced a temporary stamp duty cut, which has pushed sales and prices through the roof. But experts are really worried about what's going to happen when this comes to an end in March, particularly because it's going to coincide with the end of a number of support schemes, such as furlough. Analysts' predictions vary, but quite a few of them are predicting house price falls for next year. Well, at the moment, Britain gets between 5 and 12% of its gas and electricity from Europe, and there could definitely be some supply problems after Brexit, which could push prices up for consumers. In terms of your home insurance, there shouldn't really be any changes because that's more linked to other risk factors such as coronavirus or flooding. But there could definitely be changes to car insurance, particularly if there's tariffs or restrictions that mean it's harder to get parts imported. So since 2016, Britain's stock market has lagged behind most other major countries, such as America and China. But that's not just been down to Brexit. Coronavirus has also hit the economy really hard, and Britain doesn't have that many of these innovative tech companies that have been really successful in recent years. When you've got investments that are doing badly, it's really tempting to sell out. But actually that just means crystallizing those losses, and you could end up missing out if there's a recovery afterwards. A weaker currency also doesn't have to be bad news for British companies. A lot of big FTSE 100 firms make a lot of their profits abroad, and they could get a boost when converting those profits back into sterling when the currency's weak. But then equally, the opposite is true if the value of sterling goes up. Currently, if you're an expat pensioner in the EU, you get the same benefits to your state pension as if you lived in Britain, which is the triple lock guarantee. The government said that it's going to extend this until March 2023, so you'll still get an increase to your state pension of 2.5% or more. But if you're moving to the EU after January, you don't have that same guarantee, and we don't yet know what the rights will be. If you're transferring a private pension from Britain to the EU, I'd say you should think about doing it sooner rather than later, because there could be tax to pay after January.